Welcome to a special ACCA Technical Edge edition of our deep dive. I mean, imagine handing your entire life savings over to a total stranger.
Right. Just handing it all over.
Yeah, you legally allow them to do absolutely whatever they want with it, and you only get to check in on their progress maybe once a year. That sounds completely insane.
Oh, absolutely. It sounds like a guaranteed way to lose everything.
But if you own stock in a large public company or, if you have a pension fund, that is exactly what you are doing every single day. So, okay, let's unpack this.
It really is a massive leap of faith when you think about it.
It is. Today, we are diving into corporate governance, the board of directors, and standing committees. By the time we wrap up, you are going to understand exactly how power is balanced in a massive corporation.
And we'll cover the specific structures that are heavily tested in your ACCA, BT, and FBT syllabus.
Exactly. Plus the underlying psychology of why bad governance brings down seemingly invincible companies.
It really is the ultimate system of corporate checks and balances. And if we want the absolute simplest, most concise definition of what we're dealing with today, we can look at the 1992 Cadbury Report from the UK.
Ah, the classic Cadbury Report.
Right. It stated simply, corporate governance is the system by which companies are directed and controlled. That's it.
I love that definition because it cuts right through all the corporate jargon.
Right.
To really visualize this, think of a massive ocean liner.
Okay, an ocean liner. I like that.
Right. So the passengers who bought tickets to be on the journey, they are the shareholders. The captain and the officers steering the ship, they're the board of directors.
That makes perfect sense.
Corporate governance isn't the engine of the ship. It's the navigation protocols, the radar systems, and, the mutiny prevention rules.
Yeah, the rules ensuring the captain doesn't crash the ship into an iceberg.
Exactly. Or decide to take it on a personal joyride with the passengers' money.
That ship analogy perfectly captures the central tension in all of this, because the passengers are not the ones with their hands on the wheel.
No, they are just sitting in their cabins hoping for the best.
Right. And that brings us to the root cause of almost every major corporate failure in history. It's the separation of ownership and control. This dynamic creates something economists call the agency problem.
Let's bring this down to earth and see how the agency problem actually plays out. If the shareholders are the owners, why don't they just run the company themselves?
Well, usually there are just too many of them, and they don't have the specific expertise.
Okay, so imagine a business called Polly's Pastries. It started as a small local bakery, but Polly, the founder, is a brilliant baker. The company grows massively, and eventually, she takes it public on the stock market.
Good for Polly.
Yeah. So Polly takes on the role of chief executive officer. Her brother, Paul, is a numbers whiz, so he serves as the finance director.
So they are running the day-to-day operations.
Exactly. Because they work full-time running those functional day-to-day areas of the bakery, they are known as the executive directors.
Now, to fund a massive national expansion, they take investment money from Sarah, a new shareholder who buys a significant chunk of stock.
Okay.
But Sarah has a full-time job of her own. She isn't in the bakery every day, checking the ovens, counting the inventory, or, looking at the bank accounts.
Right, and that right there is the core of the agency problem. Sarah is the principal, the ultimate owner. Polly and Paul are the agents, the managers hired to run things.
Exactly.
Sarah has to be sitting at home worrying, what if Polly decides to use the company's newfound wealth to buy a luxury yacht and just writes it off in the ledger as a corporate retreat expense?
Which happens more than you'd think. The vulnerability for Sarah is that the information she relies on to check her investment is largely historical and subjective.
She only sees the financial statements after the year is already over.
Right. By the time she finds out about Polly's yacht, her investment money is already gone. Furthermore, true performance in business takes years to judge.
So if Polly decides to completely pivot the company strategy from baked goods to, say, frozen vegan health foods,
Sarah won't know if that was a genius pivot or a fatal mistake until 3 or 4 years down the line. She is taking a massive leap of faith.
she has to place complete trust in Polly and Paul. She is trusting them to balance risk, to put strong internal controls in place, and to act ethically.
And crucially, not to abuse their immense power.
And for everyone listening, this is exactly why this topic is so heavily tested in your ACCA exams. Examiners know that when that trust is broken, the fallout is devastating.
Devastating for everyone involved.
Yeah, they want future accountants to be the ultimate safeguard against this.
And we have seen that catastrophic fallout time and time again. What's fascinating here is that being legally compliant does not automatically mean a company has sound corporate governance.
Wait, really? So you can follow the law and still have terrible governance?
Absolutely. The rules of the law are just a baseline. The Cadbury report we just mentioned, it was actually commissioned shortly after the shocking collapse of Maxwell Communications in the UK.
Oh, right. That was Robert Maxwell's massive publishing empire, right?
Yes, a massive global titan. And the actions that caused its downfall were, for a long time, mostly legal.
That is wild.
Robert Maxwell concentrated immense power entirely in his own hands. There was no internal pushback, no independent oversight.
So nobody could tell him no.
Exactly. To finance aggressive, leveraged growth, the company began borrowing heavily from its own employee pension funds.
Which is just horrifying to think about. He was essentially raiding his own employees' retirement savings to fuel his corporate ambitions.
It was devastating. When the empire finally collapsed under a mountain of debt, thousands of people lost their life savings.
Wow.
That catastrophe forced the financial world to wake up and realize that the law alone isn't enough to protect stakeholders. We needed formal, structural systems of direction and control.
It's amazing how much of corporate regulation is written in blood, so to speak. We see a disaster and then we build a wall to stop it from happening again.
That is the historical pattern. We saw with Polypec International, a high-flying conglomerate that collapsed due to massive debts and a CEO moving millions offshore while the board stood by.
Oh, and over in the U.S., you had the infamous Enron and WorldCom scandals in the early 2000s.
Exactly. Enron executives used incredibly complex off-balance sheet partnerships to hide massive debts and artificially inflate profits.
And the board of directors completely failed to ask the right questions or rein in the executive team.
They completely failed.
And the fallout from Enron and WorldCom was so severe, it literally forced the U.S. government to step in with the Sarbanes-Oxley Act, which fundamentally changed how corporations are governed.
Right, and we saw the same systemic failure again during the 2008 credit crisis. Banking executives were heavily incentivized by massive bonuses to take on reckless short-term risks with subprime mortgages.
Right, and when the bubble burst, it caused a global economic meltdown.
In every single one of these cases, the failure wasn't just a bad business model. It was a failure of the people in the room whose sole job was to watch the executives.
If the stakes are that high, and we're relying on these oversight structures to keep companies honest, we have to look at the rule books. Like, how do different countries actually force these corporate boards to behave?
Broadly, the global financial system is split into two main approaches. The U.S., driven by the trauma of Enron, uses a strict rules-based approach.
Okay, rules-based.
Yes, this is enshrined in mandatory laws like Sarbanes-Oxley and enforced by regulatory bodies. You must follow the governance rules exactly as written, or you face severe legal penalties and massive fines.
Very black and white. You break the rule, you pay the price.
Contrast that with the UK, Australia, and many other nations, which use a principles-based approach.
Principles-based. How is that different?
This establishes a comprehensive set of best practices rather than rigid laws. The golden rule in this system is comply or explain.
Comply or explain.
Right. If a listed company feels it is actually in their best operational interest to not follow a specific governance standard, they are legally allowed to deviate. But they must fully disclose this deviation to their shareholders and explain their reasoning in their annual report.
Okay, I have to push back on that UK model. Comply or explain. That sounds like a massive loophole.
It does sound a bit soft.
Yeah, isn't that just a get-out-of-jail-free card for executives to break the rules whenever they feel like it, as long as they write a nice fluffy paragraph about it?
It sounds incredibly soft on paper, but in practice, it carries a lot of weight. Adhering to that comply or explain requirement is usually a strict condition of stock exchange membership.
Oh, I see.
It forces companies into complete transparency. If a board decides to deviate from best practices, they'll have to publicly justify it to the entire financial market.
But surely if Polly's Pastries is making money and paying out great dividends, Sarah and the other shareholders won't care if Polly breaks a few governance best practices.
You would think so.
Yeah, like as long as the stock price goes up, why would the market care about the explanation?
You're hitting on a common misconception there. You have to look at who actually holds the power in the modern market. We aren't just talking about individual retail investors like Sarah.
Right, there are bigger players.
Exactly. We are talking about massive institutional investors, pension funds, mutual funds, insurance companies. They hold billions of dollars of stock.
Ah.
These institutions have entire teams dedicated solely to analyzing corporate governance. because history has taught them that bad governance today equals a stock crash tomorrow.
So if Polly writes an explanation that boils down to, well, I didn't want anyone checking my math.
Those institutional investors will instantly sell off millions of shares.
I see the mechanism now. So it relies entirely on market discipline. The institutions will dump the stock, the share price will plummet overnight, and Polly will find herself out of a job.
Exactly. It's a self-policing system.
In other words, some countries guide you with flexible principles backed by the brutal discipline of the free market, while others bind you with strict mandatory laws.
That is the perfect way to summarize it. So, if we are relying on these structures to keep companies honest, we need to look closely at who is actually sitting at the table making these calls.
Let's go back to Polly's pastries. Sarah, the investor, needs proxies. She needs people in the room to watch Polly and Paul on her behalf.
That is the fundamental function of the board of directors. Now, for the ACCA paper FAB, you're primarily focused on the unitary board model, which is common in the UK, the US, and many other regions.
Unitary meaning just one.
Exactly. This means all the directors sit together around one single boardroom table, making joint strategic decisions.
Which is different from the two-tier structure you see in places like Germany, where there is a supervisory board sitting physically separate and above an operating board.
Yes, very different. But sticking to our single unitary table, who is in those chairs?
Right. Who are these people?
You have two very distinct types of directors. First, you have the executive directors, or EDs. These are full-time employees. They run the functional, day-to-day operations.
Like Polly and Paul.
Right. Polly is the CEO. Paul is the finance director. They are the insiders. They're usually recruited directly by the board, and because they are running the business daily, they receive a high basic salary plus performance-related bonuses.
And sitting right next to them are Sarah's proxies, the non-executive directors, or NEDs.
Yes. Non-executive directors are outsiders. They are not employees of the company. They work part-time, usually for a flat, fixed fee to ensure their pay isn't dangerously tied to short-term profits.
So they don't get bonuses for juicing the numbers.
Exactly. They often have full-time jobs elsewhere or are retired industry experts, bringing valuable external perspective. The Higgs report summarized their job beautifully.
What'd they say?
They said NEDs are there to contribute to the strategic plan, scrutinize the performance of the executives, provide an objective view on risk, and handle sensitive people issues.
If I'm Sarah, I want to make sure Polly and Paul can't just outvote the outsiders whenever they want to do something incredibly risky.
That is a very valid concern.
And for anyone listening who is sitting the exam, this brings us to a massive tip. When you're looking at board composition questions, remember that best practice dictates a public company should have more independent non-executive directors than executive directors.
That ratio is a vital safeguard. You need the independent voices to outnumber internal management to prevent groupthink.
Because internal managers will naturally agree with the CEO out of self-preservation, right? The CEO controls their promotions and salaries.
Yes, you need outsiders who aren't afraid to say no. Think of massive global brands. Tesco, the supermarket giant, operates with 5 executive directors, but 8 independent non-executives.
Wow, an 8-to-5 ratio.
Yeah. Swire Pacific in Hong Kong has 8 executives to 10 non-executives. You have to stack the deck in favor of oversight.
Here's where it gets really interesting. The syllabus introduces a concept that genuinely sounds like it belongs in a spy novel, the shadow director.
Oh yes, the shadow director.
What happens when the person pulling the strings isn't even sitting at the table?
It's a fascinating legal concept. A shadow director is an unconnected person who is not officially appointed to the board, but who indirectly dictates the actions of the actual directors.
Okay, imagine if Polly and Paul have an incredibly wealthy, domineering uncle who never steps foot in the bakery.
Right, Uncle Joe.
Yeah, but he calls them every single night and tells them exactly who to hire, what rival bakeries to buy, and how to report their taxes.
And because they rely on his money or influence, they just blindly follow his instructions.
Exactly.
Well, if the board is accustomed to acting on this uncle's instructions, the law in many jurisdictions will pierce the corporate veil.
Meaning they ignore the official title?
Exactly. It will treat that uncle as a shadow director, making him fully legally accountable for the company's actions and any corporate failures, just as if his name was officially on the letterhead.
That's incredible. The law looks past the fancy titles and goes straight for the actual source of power. In other words, you have the insiders running the engine, the outsiders keeping them honest, and the law watching the shadows.
That brings us to a massive structural vulnerability. Even with a room full of independent outsiders, what happens if the person running the boardroom is the same person running the company?
Oh, that violates the absolute golden rule of corporate governance, the segregation of power. At the highest level, the chairman of the board and the chief executive officer must not be the same person.
They simply cannot be the same person.
And here is your second big exam tip. They love to blur the lines between these two roles in multiple choice questions. It's a classic trap. You have to separate them in your mind. The chairman leads the board. The CEO leads the company.
That's the perfect way to delineate it. The chairman is usually a non-executive director. Their job is to manage the boardroom itself.
So they run the meetings.
Yes, they ensure everyone has a voice, they set the agenda, they maintain order, and they make sure the non-executives are getting all the unbiased information they need.
And the CEO.
The CEO, on the other hand, is the head of the executive team. They manage the daily operational performance of the business.
So if Polly was both the CEO and the chairman, she would be setting the agenda for the very meetings where she is supposed to be scrutinized.
Exactly.
She could just refuse to put Polly's yacht expenses on the agenda, and the non-executives couldn't easily force the issue.
It concentrates a dangerous amount of power. It has happened. Marks and Spencer in the UK famously had one person holding both roles for years.
Oh, really? Did it work out?
Well, while it wasn't illegal, it caused massive friction with shareholders and is strongly advised against by modern governance codes. The same logic applies to the company secretary.
Right, the person handling the administration, the minute-taking, and government liaison.
Right. The secretary should absolutely not be the chairman either, because that could severely compromise the vital flow of unbiased information to the board.
You are deliberately separating power so no single individual holds all the cards. In other words, true governance requires segregating these specific roles so no one can operate in the dark.
Perfectly said.
So we've separated the top roles. Polly is the CEO running the bakery. We brought in a retired local bank manager to be the chairman running the board.
A very safe choice.
Yeah. But a board only meets a few times a year. How does this group of part-timers actually dig into the complex weeds of Paul's financial reports?
They do it through standing committees. These are permanent subsets of the board delegated to handle specific, highly sensitive tasks.
And for the syllabus, you need to deeply understand two main ones, the audit committee and the remuneration committee.
Let's start with the audit committee.
Okay, so if I'm Sarah the investor, I'm looking at Paul the finance director and thinking, you're Polly's brother. You have every incentive to make the bakery look more profitable than it actually is to keep your job.
The conflict of interest is obvious.
Exactly. I cannot trust you to grade your own homework. There has to be a mechanism to check his math before I see the annual report.
That mechanism is the audit committee. Their job is to oversee internal controls, manage whistleblower reports, and crucially, review the financial statements before the full board signs off on them.
Wait, so they review the financials before the rest of the board even sees them?
Exactly, before. They're also the ones who liaise directly with the external auditors. And because of the highly technical nature of this work, best practice dictates that at least one member must have recent, relevant financial expertise.
Which brings us to the most critical rule of all, and this is your final major exam tip. If you get a question asking about the composition of the audit committee or the remuneration committee, you must immediately eliminate any multiple choice option that includes an executive director.
0 executives are allowed on these committees. None.
None at all.
They must be made up entirely of independent, non-executive directors. If Paul sat on the audit committee, he would be auditing his own ledgers.
Which is pointless.
Right. He could hide a massive hole in the accounts and no one would know. It completely defeats the purpose of independent oversight.
And that logic applies perfectly to the remuneration committee as well.
Completely. The remuneration committee is responsible for setting the pay packages and bonuses for the executive directors.
So if Polly sat on this committee, she would literally be writing her own bonus checks.
Human nature being what it is, that is a guaranteed recipe for disaster.
But let's dig into the mechanism of that disaster because it's fascinating. It's not just about Polly paying herself too much base salary.
Right. The base salary is just one part.
Which, by the way, remember this nuance for your exam. Increasing a chief executive's basic salary serves the purpose of attracting and retaining talent. It doesn't magically guarantee a short-term increase in their productivity.
The real danger lies in the performance bonuses, right?
Exactly.
The bonuses are where the math gets dangerous. Suppose Polly's bonus is tied solely to hitting a massive profit target this current year. She could artificially inflate this year's profits by quietly slashing the research and development budget or firing the entire quality control team.
Oh, wow. So the bakery looks wildly profitable on paper right now. Polly gets a massive multi-million-dollar payout, but she has secretly destroyed the company's future.
Exactly. 2 years later, the pastries taste terrible, competitors take over, the stock crashes, and Sarah loses her entire investment.
That is the exact mechanism of short-termism that caused the 2008 banking crisis. Executives took massive risks to juice their bonuses, knowing they would be long gone with millions in the bank by the time the consequences hit.
The Remuneration Committee's job is to structure pay to prevent that exact scenario. They design packages that motivate long-term sustainable success,
Like how?
maybe by tying bonuses to share price performance over a rolling 5-year period rather than a single quarter. And again, doing that effectively requires total independence from the executives.
In other words, true corporate governance requires recognizing the flaws in human nature, separating power, and building a system where no single person holds all the cards.
That is the true value of everything we've discussed today.
It's a brilliantly designed system, but it does leave us with a lingering question. So, what does this all mean for your exam? Well, we covered the tips, but if we connect this all back to the bigger picture and that concept of the shadow director we discussed earlier.
It's a crucial thought experiment. If all of these intricate governance rules are designed to so carefully balance power among the people sitting visibly around a formal boardroom table,
Right.
how much hidden systemic damage can a shadow director really do behind the scenes before the legal system manages to catch up with them?
It is a brilliant and slightly terrifying thought to leave on. If the strings are invisible, how do you know who is really steering the ship?
It really makes you think.
That is definitely something for you to mull over as you continue your studies. We want to thank you so much for joining us on this deep dive today. Please remember to follow the show on Spotify and leave us a review.
It really helps us out.
Keep going with your ACCA journey. Understanding this material doesn't just help you pass exams, it prepares you to be a vital guardian of the financial world. Thank you for listening.